Ethereum blasting past $4,250 today, the highest sustained level since December 2021, is the kind of market event that forces everyone from floor traders to institutional allocators to update their models because it combines brute force, price action, a 19% weekly move, and a strong 24-hour pop that wiped out a vast pool of short bets with shifting market structure and fresh on-chain flows. Some analysts are already daring to sketch a path toward $12,000 if this breakout holds, while skeptics warn that a violent short squeeze pop can be nothing more than a trap that reverses as quickly as it arrived. The immediate mechanics are straightforward. Concentrated rush into longs and a cascade of short liquidations create a feedback loop stops or hit. Forced buying closes shorts, price climbs further, and momentum traders pile in, and that loop this time reportedly erased roughly $200 million in short positions. Magnitude that delivers both a velocity advantage to bulls and a vulnerability if momentum stalls. But beyond the fireworks, the deeper question for anyone with skin in the game is whether this is the start of a multi-year structural bull run toward 4- or 5-figure targets, or merely a high-velocity repricing event vulnerable to a steep mean reversion. To answer that, you need to weigh 5 interlocking lenses: technical structure, constant demand, institutional plumbing and products, macro liquidity context, and the risk anatomy baked into derivatives and order book microstructure. And the truth about the $12,000 narrative is that parts of the foundation are in place, while other critical pieces are still missing or fragile. On the bullish checklist first, price structure matters. Breaking a multi-year resistance zone changes the game for trend followers and funds that apply mechanical rules. A weekly close above the old ceiling converts former sellers into support and gives algorithmic allocators license to increase exposure. Yet even those analysts who celebrate the breakout caution that confirmation, a sustained close above the resistance on higher time frame candles, is the validating step, not the intraday spike itself. Second, on-chain indicators show a meaningful influx of new demand. Glassnode and other analytics platforms flagged that the number of first-time ETH buyers and momentum traders rose sharply in the run-up to and during the breakout, suggesting fresh retail and perhaps some institutional participation is fueling the move rather than a pure re-rating by existing holders. Third, the institutional narrative is strengthening. The mere existence and growth of spot ETH ETFs, plus discussion of derivative products that could package staking exposure for large allocators, creates plausible pathways for billions of new capital to enter markets in a way that is operationally simpler for pension funds and asset managers than direct custody. Voices like Crypto Rover argue that a formal product such as a BlackRock spot staking ETF could act as a liquidity supercharger that vaults ETH to new numeric landscapes 6,000 USD and beyond in his scenario, by concentrating demand and permanently reducing circulating sell pressure from staking flows. Combine those items: structural breakout, demonstrable demand from new buyer cohorts, the prospect of institutional gateway products, and you have the triangular architecture bulls point to when they sketch multi-$1,000 price targets. But the opposing case is substantial and methodical. And it's worth rehearsing because the fastest rallies often produce the harshest pullbacks. First, liquidity and microstructure caveats. The same short liquidation mechanics that accelerate rallies can create fragile price environments because they do not necessarily reflect organic, long-term buying. Rather, a large portion of the move can be mechanical: traders forced out of shorts, market makers hedging, algorithms buying gamma, and once that mechanical flow finishes, there needs to be fresh, non-levered capital to sustain the next leg. If that follow-through capital is absent, or if it is quickly supplied by participants with shorter time horizons, the price can tumble back below the breakout zone just as fast as it popped. Second, derivatives leverage amplifies both directions. Open interest in ETH futures is elevated, and when many players are leveraged on either side, the path of least resistance can change quickly as funding rates and position skew shift. A hawkish macro print or a sudden liquidity withdrawal can flip sentiment and produce rapid deleveraging that hits leveraged longs first. Third, the structural institutional story contains execution risk and sequencing uncertainty. The idea that a single approval or product launch, for example, an ETF that directly packages staking exposure from a major asset manager will instantaneously re-rate ETH by several multiples, presumes not only regulatory green lights, but also operational adoption, large flows, and the timing of when investors actually deploy capital. And history shows fund approval rarely equals immediate trillion-dollar allocations. The BlackRock narrative is powerful and plausible, but it's a multi-stage process, not an instantaneous faucet. Anticipation can drive bubbles as much as actual flows. There's also an important nuance in the composition of demand today. Glassnode's data, which shows a meaningful uptick in first-time buyers and momentum traders, can be read two ways. It could indicate a healthy widening of base with new users onboarding, which is durable if those users stick around and are matched by real utility DeFi growth, tokenization activity, institutional use cases. Or it could mean that retail is FOMOing into a headline breakout, which historically correlates with elevated risk of drawdowns if large liquidity providers choose to take profit into the rally. The NVT and related ratios across ETH have occasionally shown valuation pressures outpacing on-chain transactional growth in past cycles. Price outstrips real economic activity for long enough. The rally risks becoming a speculation seed rather than an adoption story. Bulls will argue that tokenization, DeFi expansion, L2 adoption, and staking products are precisely the channels that will convert speculative interest into fundamental demand, and that's a credible roadmap. But until we observe comparable increases in TVL settlement flow and institutional custody volumes, the bullish thesis remains partly aspirational. From a purely risk management perspective, that ambiguity means positioning should be measured, scaling and hedging, and using defined risk instruments. This makes more sense than levered one-way bets that assume the breakout is bulletproof. Another pillar of the bullish narrative is reflexivity, the way narratives feed flows. The visual of $200 million plus in shorts being liquidated is itself a magnet. It attracts media attention, inflames social chatter, and brings in retail precisely the ingredients that can suck in momentum for an extended period. Participant psychology matters. When influential voices declare that ETH is breaking a 4-year resistance and that targets of multiple thousands are plausible, that narrative can become self-fulfilling for a while as more capital chases the move. Yet reflexivity can also work the other way. The louder the narrative, the greater the risk of a violent whipsaw when any catalyst, a macro surprise, a protocol vulnerability, regulatory comments, punctures confidence. The present environment also has actors incentivized to profit from narrative-driven cycles. Liquidity providers and some whales can orchestrate or at least amplify short squeezes and then distribute into the ensuing frenzy. That's why experienced market observers caution that a breakout needs corroboration from independent signals. Sustained spot outflows to custody, improving derivative structure, for example, reduced leverage skew and confirmed on-chain growth, before one upgrades the probability of $12,000 from stylized to probable. Let's be concrete about scenarios. In the bullish staircase scenario, ETH confirms a weekly close above the multi-year resistance. Institutional product approvals or credible progress on them continue. Spot ETF flows and staking-backed products bring meaningful fresh capital and on-chain usage transactions, TVL. Active addresses accelerates in that environment. A path to $6,000 becomes reasonable, and $12,000 could be in the realm of multi-year valuation expansion as financialization and tokenization converge. In the bearish mean reversion scenario, as the rally is dominated by short squeezes and retail FOMO, derivatives leverage remains asymmetric. A macro tightening event drains liquidity, and headline risk materializes a regulatory announcement, a major protocol exploit, or a liquidity shock in that case. ETH could retest lower supports below the breakout, and many momentum players would be stopped out in a violent slide. Both scenarios are plausible. The difference comes down to whether the breakout is validated by follow-through volume, durable capital inflows, and measured changes in structural indicators.